Good afternoon, everyone. Welcome, and thank you very much for joining the webinar. I have had a look at the registrations, and great to see some familiar names on there. Today, we are exploring what could be a generational opportunity in UK equities at a time where global investors have been heavily concentrated in the US markets, particularly in the much discussed Magnificent Seven. UK equities are trading at a historic discount to the global peers. When you look over the last 3 decades, we have seen 41 months of outflows from UK equities, and then in November, for the first time, we saw some inflows. And whilst that wasn't continued in December, it was modest outflows in December. We continue to see bid activity for UK companies, Renewy, Team Internet, Dowlays most recently, which is a sign that sophisticated investors are recognizing the value of the UK markets. When we talk to investors, there is definitely a call for greater demand for diversification. Last year, if you look at last year's performance, the Magnificent Seven delivered 67% return. The rest of the 493 of the remaining S&P delivered a 5% return. That gave you an idea of the extremes that you saw in the market. I think there's quite a lot of concern about whether that's possible, whether there's any possibility that that continues. We're very fortunate to be joined by a panel of experienced fund managers to explain and explore whether this is a temporary shift or something that is a start of a more meaningful journey for UK equities. I will get them to introduce themselves, but before I do, I just need to caveat that none of the ideas presented by the panelists should be construed as representing investment ideas or recommendations to invest in any particular security. We are going to try and run for somewhere between 30 and 40 minutes as a panel discussion. You have the opportunity to ask questions, so please do type in the questions, and we will try and bring answers to you at the end of the seminar. If I could get my panelists to introduce themselves, starting with James Henderson.
I run 3 investment trusts: Lord Abenture, Lowland, and Henderson Opportunities. They are multi-cap funds, large, medium, and small companies, predominantly in the UK. I've done one of the funds since 1990, and I've done the most recent started in 2005.
James, thank you. And next, James Loan. James, could you briefly introduce yourself and the funds you manage?
Thanks, Neil. I'm James Lowen. I work at J. Hamburg Capital Management. I run the UK Equity Income Fund here. Not quite as long longevity as James Henderson, but last year was our 20th anniversary. So I've been here with Clive Beagles, who I co-manage this with for 21 years. It's the income fund, so it's very focused on dividends, yield, valuation, contrarianism. And if you look back over those 20 years, sort of 2 of the outputs of the process has been the dividend growth. We've grown the dividend by 9% compound over 20 years, which we're quite proud of. And they're sort of directly related to that. Secondly, we're the best performing income fund in the UK over those 20 years.
Thank you. And to provide a slightly more a US but also a global perspective, delighted to have longtime friend of Edison's, Randy Barron. Randy, maybe you could introduce yourself and the funds you manage.
Well, as my accent makes clear, I represent the other side of the Atlantic. I represent a firm called Pinnacle Associates. We are a $10 billion long-only asset manager out of New York. I'm responsible for all international strategies, and like James Henderson, we have a couple of those in ADR or global macro. But the thing which suggests that I'm a glutton for punishment that I enjoy the most is international small cap. And about 30 to 40% of that strategy is the UK. So I'm a pariah.
Okay, so you definitely, and we know that you bought into the UK market. I mean, to start off with, I'll direct the question to you, James Henderson, because of the longevity. You've got a view in terms, I think, which spans multiple cycles. If people are looking around at diversifying out of the US market, and part of the reason for putting this on and writing the thematic piece we put out in December was as we speak to US-based investors, we were very surprised that actually the thing they were asking for was value and yield. Maybe you could just put the pitch as to why should they direct capital to the UK versus some of the other markets, Europe, emerging markets. What's the appeal of the UK market? And then perhaps put a little bit of the context, the valuation context, into history. So 40% discount to global peers. In your experience of managing UK portfolios through multiple cycles, how's that compare? How's that disconnect to history? And perhaps what might change that going forwards?
I think this is different to other cycles for me in that the UK has seen events have come together. We've seen money leave the UK by international investors. It almost starts with that Brexit vote when people began to think the UK was a bit of a sideshow, no longer part of Europe. There was uncertainty was brought in, and those international investors. I remember arguing with some the week after Brexit vote, trying to persuade them to stay, failed, and they did well to fail. I did well to fail because they've done much better with their American stocks over the period. But that was the start of a trend of people selling down their UK weightings. We've seen the pension fund industry, we've seen the life companies, we've seen institutions generally leave the UK equity market for the reasons that, to begin with, that there was uncertainty. To begin with, there was probably over-owned by some of them. Why not be a bit more international? But that sort of fed on itself, and now we've reached the point where the UK pension fund weightings are down to very low levels. We've got the retail investor enjoying Randy's market much more, and the success of the Magnificent Seven has now dragged money out of the UK to help feed it further, and that has left the UK in quite an interesting position because the multiples are lower than I've seen before. Usually, when you see low multiples this low, the earnings are about to implode. There is the market is discounting some horror in the economy when they occasionally get this low. But this time it's a bit different. This time the companies themselves are very disciplined. The managing directors that have come to the top of these companies have dealt with cost of living crises. They've dealt with uncertainties over trade. They've dealt with COVID. They know how to manage expectations, and you manage expectations by being pretty miserable much of the time at the moment in the UK, because there's always something that comes along and makes it so difficult. So those expectations are satisfactorily low, and if we just get a bit of top line growth on these well-disciplined cost bases that these managers have got, we're going to be surprised by the earnings growth. We'll be surprised by the profits growth, and that's from low multiples. So we could be looking at a bit further out of earnings going up and valuations from these low levels going up. And as I say, I haven't seen this low with the thought that earnings are actually going to surprise on the upside in places. It'll take time and there'll be disappointments on the way, but that's a nice background. The background is almost similar to the background. Neil was saying how long I've done it. When we started in the late 70s, early 80s. Expectations were mighty low about the UK. We'd had the winter of discontent. Everyone told everyone else, one another, we told, the UK was awful, and only some silly fools stayed investing in the UK. The next 20 years were good. The expectations were suitably low, and the UK outperformed many markets for the next 20 years. It feels almost as difficult now as it did then. All the economists were writing the UK off. They're doing that again. They will change, but what gets them to change is a little bit of surprise. They'll always be behind the curve, but with a bit of growth, top line will come through in better sales for companies. That will lead to better margins, and actually all these things can turn. So that's why I'm excited. Thank you, Neil.
Thanks, James. And look, towards the end of the conversation, I hope to bring it to life by talking about a couple of stocks. But James Lowen, if I could get you to sort of add any perspective to that.
Well, I very much concur with James Henderson. I think one of the things that's most exciting at the moment is our companies are performing very well. So I actually look forward to opening the RNS feeds in the morning. If you go back to 2008-9, most of the updates were negative profit warnings and rights issues. So we're in a very different place now with the same valuations. But I think what is also happening now is people are starting to recognise this sort of ridiculous valuation architecture we've got and are taking action. So we've seen, and we'll probably pick up on this one a bit later, but we've seen the UK under attack from an M&A perspective. And a lot of that is coming from the US to the UK, arbitraging the valuation. So I had 6 bids out of 60 stocks last year. So that's creating value if it's done at the right price. That's the first thing. The second thing I think is happening as we speak is that the Labour government, which has had a very slow start with the budget and talking down the economy for the second half of last year, has realised that it's flatlined things here. And in the last 2 weeks, we've seen day after day policy announcements, whether it's sacking the CMA head, it's relaxing bank regulations like the Basel III deferral, or planning reform. So we're seeing quite a potent policy deregulation reversal, which I think will help growth and also help the perception of the UK. And then finally, the third thing I think is happening is again linking back to politicians. They're realising that our capital or markets are being hollowed out, with buybacks, with the M&A, with companies like Flutter moving towards where Randy lives last year. So the market's getting smaller and smaller, and they're realising this is having an economic impact. So I think we will see, as we go through this year, some sort of policy action where they mandate ownership of UK equities in defined contribution schemes, or they reform the ISA structure to make it more focused on UK assets, because they're spending a lot of money on tax relief for these type of sort of investments or allocations, but a lot of the money is being sucked towards Randy's shores. So I think the combination of those 3 things I've just said, plus what James Henderson was saying about the corporate mojo, if you like, leaves us very excited as we look forward to the rest of this year.
Thank you. And then Randy, I mean, you live and breathe it, right? You're at the heart of it. You probably, wake up to CNBC flashing what's happening in the Magnificent Seven. I would love to get a sort of US perspective on, yes, there's the concept of US exceptionalism is there. We see the growth dynamics. We see, a very positive administration talking about, what it's going to do. And I can touch on that later. But there's a price to pay for it. Yeah, I would love to get your understanding in terms of the valuation metrics you're looking at and the dynamics you're looking at when you're screening through your universe.
Okay, I made some notes as both the Jameses were talking, and I didn't expect to come up with this, but people have logged on to talk about equity markets and securities and the generational opportunity. But I wrote something down, James Henderson, as you were talking about HALE, HALE. So people know acronym like TINA, there's no alternative, et cetera. I'm going to introduce your audience to a term which is appropriate for equities, but also appropriate for marriage. Okay, people come for equities. We're going to save marriages too. The secret to both is HALE, high aspirations, low expectations. Right? I mean, that's effectively what James Henderson was talking about. And yeah. I agree with you, James, about the winter of discontent. I mean, Neil, there was a time maybe 2 or 3 years ago when I was in your studio and we talked about even mushrooms grow in the dark, right? Yes. And so for an equity stock picker, which I am a bottom-up stock picker, I think generational opportunity is a bit of hyperbole, but I do think that it's morning time in the UK, right? The darkness is kind of the post-Brexit darkness. Being out in the wilderness is kind of starting to shift. And if you don't mind bearing with me for 2 minutes, what I thought I would do is just share some slides that we did in our year-end report to our investors, just to quantify what we all are talking about. So here is you guys can tell me if this comes up, but this is good. All right, we can see it. So this first slide, is showing just in a market snapshot by large, mid, and small cap. This is as of year end, current PE versus the 20-year trailing. And by the way, if I did cyclical PE, it'd be even more aggressive. But the idea of, take large cap growth, for example, which is on the left side of your screen, upper right quadrant, trading at almost 29 times PE versus a 20-year history of 19 times, right? And the right side of this shows a percentage dislocation. But the point is, if you left Brexit, there was maybe 5 multiple points difference on PE between the UK and the US. The UK's valuations have gone down. The US has gone up, like you said. And so today you're sitting somewhere, north of 21 and a half, almost 22 times PE, and the FTSE 100 at 11. So call it a 10-point difference. So I just think it's fascinating. Part of the reason for that, and this is really hard to see, this breaks out the same idea, but by sector. And I put a star here to show the major difference, which is consumer discretionary and tech. So tech in the US is over 10 points higher than its average on a standalone basis. And of course, this is almost 30% of our benchmark. When you compare that to the UK, 1% of the benchmark. And one popular reason for having been long US over European, including UK equities, is the S&P's exposure to AI and to tech. But on the flip side of that, high performance concentration and extreme positioning in only a few US stocks comes at risk. And that's part of why, we prefer looking for these opportunities in England and other places in the UK. Neil, you touched on it at the top, but the market weighted PE of the Magnificent Seven is actually higher than all of these numbers. If you just take those 7, 35 times earnings, right? So it leaves little room for disappointment, as we saw this week with this DeepSeek AI, news that came out. Without the Magnificent Seven, the S&P performance of last year, total return, which is up 25%, would have been roughly up 12%. And that's shown in this next slide here, where I'm just trying to show visually, how the US market cap performance has left everyone behind. One of the interesting things on this slide is the lower left, which is percent of revenue exposure by country. The UK has over 3/4 of its companies have revenue exposure outside of the borders of the UK, which is kind of fascinating. And then the last quick things really quickly are showing on the left-hand side of this, the price to earnings discount. This is all world. This is not just UK, but just showing that we're over 2 standard deviations away from rest of world to the US. And the things that concern me going forward are 2 things. One, we took a 60-40 equity fixed income portfolio, normal allocation that people should have as you age, et cetera. And we just grew at steady state. If you go from 2019, if you look at that green section in 2019, under 30% of it was US growth. Just in the Magnificent Seven growing, et cetera, today, you're almost at 40% in that. And so I tell you that story because anecdotally, I remember sitting with the CFO last year of a UK company, and he showed me his UBS statement, and international small cap, the things that I love and do, was less than 2% of the total allocation. So kind of standing here in the wilderness is a place I like waiting for things to come to me. And the last thing, and this is the thing that scares me the most, I just wanted to put in visual form. This is the average tariff on US goods going back the last 100 years, right? So the left-hand side of this slide is the US Great Depression, the global dislocation that happened. And if you look at the general trend over time, that tariff, and then what's proposed is on the right-hand part of this slide. And if you just take the US threats, the 25% tariff against the, Mexico and Canada, you're talking an 80 basis point headwind to GDP growth, forgetting the inflation potential, and that excludes rest of world. So we're entering this moment, all that to say, where valuation matters, right? Valuation has always mattered. I think now when the Mag 7's at 35 times, valuation matters more than ever. And at least on my screen, the most compelling valuations I'm seeing currently are in the United Kingdom.
Okay, thank you, Randy. And I guess valuation matters when we talk to investors. Valuation matters because the road ahead is uncertain. You've got, the uncertainty of what the Trump administration will ultimately do and the ripple effects of that, but plenty of other things that are sort of creating uncertainty in the world. And ultimately, margin of safety starts to become more and more important. And how do you get that margin of safety? Is that sort of lower multiple, and if you've got income alongside that, even better. But when you look at James Lowen, maybe I want to sort of bring this to you. I guess that firstly, when you're looking at stocks specifically, so valuations are attractive. What are the attributes of a stock that you're looking for that helps you sort of be more resilient through that uncertainty? Well, typically, as a stock picker, what are you looking for in a company today?
Well, obviously, valuation is vital. I've got a motto I talk to clients about, that valuation risk is as dangerous as fundamental risk, because I think the biggest risk in all our jobs is that we find a stock that's got good fundamentals, but we overpay. And I think that's what's happening in the US market, as Randy has sort of highlighted at the moment. So I think the starting valuation is critical in terms of protecting your downside. The other thing we look at from a risk perspective is a strong balance sheet. So we have learnt, as we've gone through our 20-year journey here and 10 years at a place before this, that one of the biggest mistakes we can make is have a balance sheet that gets stretched when our central case and operational performance doesn't happen. So we accrue balance sheet risk when we're looking at the fundamentals of a stock. So that's sort of a sort of background valuation and balance sheet. But obviously, we're looking at the fundamental case, whether it's market share, management quality, position in the industry, the cycle. And what we try and do for all our stocks is look at the normalized earnings. So we say, what can this stock earn on a 3-year view? So one of the things we've seen over all of our careers is the timeline of the market has come in with passives and hedge funds and other market participants. So we try and sort of go beyond that and say, what can each of our stocks earn on a 3 or 4-year view? And we'll take our valuation agenda off that. And I think this is where it comes back to what James Henderson and I were saying earlier. We really have got it's like a smorgasbord of opportunity at the moment, because the corporate performance, and it's very hard to get it off the page on a call like this, but the corporate performance now versus any time in my 20 years is much, much better. So just an example of this, we've got 5 retailers, and retail's obviously sort of got negative connotations at the moment because of the national insurance in the budget, the narrative around the UK. But every single one of my 5 retailers has had a good trading update, and it comes down to one common theme: they're all taking market share. And I think that's another thing that's happening. The corporate UK is outperforming private UK, and there's capacity withdrawals in places like Homebase, which is in the DIY sector, went down last year, and that's helped Wix, one of the 5 we own. So there's lots of mini cycles, things going on in companies, whether it's this market share, capacity withdrawals, using their strong balance sheets for bolt-on acquisitions or buybacks, and that's what makes it the foundations underneath us, which I think is what James was saying, feel much stronger than they've done in previous times when we've had this valuation opportunity.
Okay, and then perhaps for James Henderson and Randy, you've had an answer of the kind of stocks and the things that you're looking for. Are you finding either themes or sectors where you're actually seeing a sort of combination of attractive valuations and sufficient tailwinds to say give you sort of confidence in terms of revenue growth? James Henderson, maybe you could start. Is any particular sector, or is it much more sort of just stock picking?
I think just taking on that, tech is so important. You can make money if you do anything really well. And I was looking at, I expect James knows this as well, but two of my most successful, the best business we've had the last 10 years in the UK, one was something like Cranswick that makes sausages, pork sausages. It just does it very, very well. And it's gone up 10 times and now has a market cap of 2.5 billion, and it's still making pork sausages, and it's doing chickens as well, and it's expanded as a business, but it's UK and it's just excellent at what it does. Another would be an unlikely thing would be somebody that galvanizes farm gates and crash barriers, and that's Hill & Smith. That has gone up 10 times. Did it in the UK, did it in France, and it's now doing it successfully in the States. These aren't glamorous industries, but if you do them well, serve your customer well, you don't have to be in a high-tech area, the importance is excellence, focus, and drive, and you can be a successful in investment. So I think success comes in so many different places. You have to be careful about concentrating, thinking that one area is overly good, because that becomes the area that attracts the capital and returns get driven down. Sometimes if you're at the ignored area, like being a galvanizer was for many years, you can actually achieve the returns without the competition and grow your business and get the traction to become a bigger company. And after all, at the end of the day, both when 10 years ago, Hill & Smith was 12 years ago was a £150 million company. It's now a £1.5 billion company. Granswick was a £250 million company. It's now 2.5. And in the little UK market, a bit different in the States, but in the little UK market, it's much easier to go up 10 times from 250 to 2.5 billion than it is from 2.5 to 25 billion. Very few people ever achieve that. So you're looking at an area where there is more chance to find that kind of one that will make up for quite a few mistakes and drive your asset value forward.
I like that, James. And, I mean, straight away, Greg's and Games Workshop are two other names that I would add into the mix of companies that have done, gone from that size into something much bigger. Randy, how about you? Are you seeing, is it that you're just sort of sharpshooting and picking individual names, or are there themes that you're finding appealing, or tech areas that you're finding appealing?
Yes, and.
Yes,
right?
okay.
So I think the beauty of the UK is it offers both.
Yeah.
Right. So you can find glamorous names, you can find compelling growth opportunities, but James Henderson, I will see your pork sausage and raise you a brick. There's a company, Brickability, that literally makes brick and cladding for buildings. It's all housing start dependent. IPO'd in 2019, it's trading at under its IPO price by 10 or 15%, 4.5 times EBITDA, 18% free cash flow yield. And in between then and now, revenue is up 3x. Part of that's for acquisitions. But the point is, that's kind of deep value with the catalyst. On the other side of it, our friend Chris Mayo introduced me to Infinity Energy Solutions. I mean, this is a kind of pre-revenue company. But when they do vanadium flow batteries. So if you think about huge container ship size batteries, how do you get into, if we all work during the day, you get home, the sun doesn't shine at night. So how do you take solar, how do you take wind and shift it into the evening time? Well, you need huge batteries. And in California, earlier this month, there was a huge lithium fire. Part of the reason that, these cell phones that we all have and the computers is that lithium has a very defined charging cycle. You only get about 3,000 charges in a lithium battery.
Yeah.
It's also flammable. Vanadium, which, flow batteries go back to Thomas Edison over 100 years, you can effectively go into infinity. And then I think also there is something fundamental about the UK versus US investor. I love that the UK investor, generally speaking, tends to be more conservative, right, than the US. US, we tend to be a little bit more on the tip of our skis. We're pushing the tip of the spear. But there's a company, one of our top positions, Victoria PLC. I mean, this was a stock. This is another home builder, second derivative play on a housing recovery. They do the carpets for Buckingham Palace. Not the reason to own it, but just a cool thing. Jeff Wilding, who's one of the best capital allocators I've seen. This was a stock. It's been, by the way, it was LSE listed in the 1960s. Okay, Now it's AIM, but it's been around a long time. This is a 12-pound stock during COVID. I was buying it in December for 40 pence. Right, mind you, it's up 80% already year to date. As Neil said, this is not a disclaimer, but we love it because it's levered, right? And they've come out. So UK, we hate leverage, right? In UK, leverage is non grata, not welcome. But they've talked about publicly that they would like to address their leverage. They have a maturity coming in 26 and maturity coming in 28. Yeah. Right. If they resolve either of those, this is a levered stub. 90% of the value is on the debt side. As that gets resolved, it transfers to equity. And we've seen this time and again. So I like the UK because of the diversity of opportunities that it presents.
Okay.
Can I just we all three of us are multi-cap, so we all do small and mid. But I think the other thing we should just point out is there is a great opportunity in large cap in the UK, which goes back to the diversity point that Randy was saying. One of the problems we've had in our large cap makeup is the low interest rates, and now interest rates have normalised. That is helping sectors like banks, and banks was one of the best performing sectors last year. In fact, 2 of the banks in the UK outperformed some of the Magnificent Seven, which isn't sort of widely reported. And then when you go to other sectors like BP, to go back to something Randy was saying about geographic mix, BP's got more US exposure than Exxon, but BP's share price would have to double to get to Exxon's rating. So you know, even when you look under the bonnets, the exposures are actually much different than people think, given the sort of name or where the company's quoted, and then the valuation gap is as stark in these large cap areas as it is in the mid and small that we talked about.
Okay, thanks, James. And then, I mean, I want to talk about, because you know, you can have low valuations for a long time. The feeling of, you know, it is about to change. Now, part of the argument is around flow. You know, that as you know, if you come out of these very large Magnificent Seven stocks, you know, water into thimbles is the idea, that it doesn't take a lot to suddenly start to sort of correct the other. The other, which I know you've been quite vocal on, James, is the reform agenda. That what is going to actually stimulate and attract people to the UK capital markets. Now, I have to say that, you know, there was a moment of hope, you know, when Jeremy Hunt gave his sort of Mansion House speech and set out a series of reforms, and we saw very little change. And I think that, you know, more recently, take something like, you know, the Sama's sort of push on a regular investment trust. In any other market, you would imagine that actually your permanent capital base would be nurtured and looked after and sort of encouraged because of the implications for growth. Now, I'm hoping that this is all a wake-up call and we see some changes. From your perspective, what is giving you confidence that you're going to start to actually see those reforms and make that market dynamic again?
Is this James Lowen, yeah?
Oh, sorry, yes.
Yeah. Well, it sort of feeds off what I was talking about earlier. I think there's lots of mood music, which my fellow panelists would have probably picked up on as well, from people that are stakeholders in this ecosystem, whether it's government ministers like Emma Reynolds, what she has been saying before she was elevated the other week to city minister, or whether it's the LSE, whether it's people on the fund management side or insurance or banking side. I think the penny has dropped now with regulators and with policymakers and with the government, that this is a major issue for economic growth. And I think that's part of the reason we've seen this sort of policy twist that I mentioned earlier with the Labour Party in the last couple of weeks, trying to deregulate things. And I was on a call yesterday with one of our bank chief executives, and he was just talking about, and this is where the US does link to the UK, he was just talking about what Trump's doing and on bank regulation, for example. We've seen, like I said earlier, the UK push back Basel III, which is part of the regulations on banks. And when they did that, they said it's because Trump has done it. And if we don't push it back here, then we'll be less competitive. So I think they're realizing that they're having to react to what's going on elsewhere. They're having to react to this flatlining of growth here. And they've got to stop the hollowing out of this UK equity market. We wrote a paper last year and we called it the melting ice lolly, because we've got M&A, which is compounding at 2% a year. We've got companies leaving, like I said earlier, like Flutter was the last one. And then we've got this massive buyback activity. So in our funds, on average, 5% of the share capital was bought back in the underlying companies yet last year, and it was the same the year before. And this compounds up. And if you add all of that together, then 15% of the market is disappearing over 2 years. And there's not, as we all know, many IPOs coming. And there's not many IPOs coming because who would list here? Because you know, why would James or Randy or I sell a stock we've got with 50, 60, 100, 200% upside, which is where our upsides reside, to buy an IPO, because it's going to probably have less prudent forecasts, to go to one of the themes that the other two have talked about, and the seller is going to want a realistic price. So that's why the IPO market's broken. So we've got to try and get this valuation structure up to stop this negative loop developing, which is currently there.
I'm going to
And
come on.
Neil, if I could just add to that, one of the interesting differences between the US and the UK, and this goes back to the conservative nature that I was talking about earlier, is, when I started in this business in the 90s, at least in the US, we still were valuing pensions, right? Pension surplus. We were looking at all that. That's not something that, we worry about with Magnificent Seven. The pension reform in part in the UK is going to happen because there's 160 billion pounds of overfunded surplus that's sitting in defined benefit plans that's got to be put to work at some point, because people on the other side, you talked about the ESA before, these individual savings accounts, 3 million people with 20,000 pounds just sitting there, right? And so that ties into the listing question, because I do think, to use the old Mark Twain idea that the claims of the death of the UK market have been exaggerated. LSE has done 2 crypto mining IPOs already this year. And when you talk with companies that are mid-cap and listed, like there's one Pension B, for example, Pension B rolls up. When you leave a job, you maybe forget that you have a retirement plan there. You go to next, you forget. Anyway, you automate, you put it in, they roll it all up. They've got 5.5 billion pounds AUM right now. They're charging somewhere between 50 basis points and a full point on that. That's a business, by the way. I talk with the CEO, Rami, who's wonderful. She talks about, she loves the position they're in, because to James Lowen's point about 10% of your companies getting bids last year, they're going to be in the FTSE 250 automatically, just as it goes. So for them, that's part of the reason why not to list immediately in the US. Like they want to stay. And, WPP leaving gets the headlines, and I understand it sucks all the oxygen from the room, but the companies that are in it see the potential and the merits of staying.
Okay, I'm going to come back to that. I just should remind the audience that please do, if you have questions for the panel, please do pop them into your box and type them in and hit answers so that we can get onto them. I mean, I think the reform is key, and hopefully something gets done about it. I would sort of hark back to actually the GFC, when we saw quite a lot of activity from treasury departments with the stock exchanges. At that point, capital for SMEs was paralyzed. Banks weren't lending, and there was questions being asked as to what could the equity market do to help that. And there were some really interesting stats that were sort of put out that actually at a time when the larger companies were letting people go, those companies that got funded created jobs, created growth, created employment. This all then goes on to fund public services, etc. So I think hopefully the sort of pennies dropping that this is a market that is going to be important, that this reform agenda is a key part of that productivity side of things. James, is there anything else that you might want to add into the sort of reform agenda?
Yes, I suppose like stock pickers, the government, the authorities usually make their next mistake by trying to avoid their last one. And the last one was that they overreacted to the financial crash by hitting banks hard and constraining them. Well, so the difference, one of the things the States got so right compared to us was you sort of drew a line under it. You moved forward. Yes, there were mistakes. Banks had made mistakes, but we got to move forward. Whilst we've made our banks for ages pay back for the mistakes they made, we're still talking about it. There's still a negative sentiment towards them, and now they're just not lending enough. That it's easier for them to take the deposit money and buy gilts. They're not out there lending to SMEs. It's incredibly difficult in the UK to get a loan for many people and for many small businesses. And this is different to the States and one of the drags in the economy. So to me, the authorities have got to realise what they've done to the banks. That yes, the banks made some bad errors 20 years ago, but really we've got to put that behind us and forget some of those and to loosen up and let banks get on. For instance, just take the mortgage market. It is so difficult for young people to get mortgages at the moment. And yet they say at the same time they talk about getting planning laws better, or actually the fastest way would be to just loosen up on the mortgage market. Yeah. We heard the Chancellor the other day saying she wants to see Heathrow built by spades in the ground by 2029, she said. Well, it'd be just so much easier to get spades in the ground by letting a few companies borrow some money and start building generally in the economy. So I think there are some. I think the States does show us what can be achieved by regulators moving forward in their thinking.
Okay, thank you. I did want to bring it to life and look at, you all manage funds, and you've talked about the different things that you're looking at in terms of valuation, relative prudence, well-run companies, etc. If we just to manage time, I was hoping to do a couple, but I'm going to get you to each talk about one stock that exemplifies the kind of investor that you are and hopefully projects the kind of things that you're looking for. So James Lowen, maybe I could start with you, just a quick elevator pitch of a kind of stock that you think actually this is what our fund is about.
Well, I've mentioned a few retailers we've got. We own Currys. Now, Currys was one of the 6 that was bid for last year, actually by a US private equity firm. It was a very low ball bid at 67p. We and some other UK shareholders rejected it publicly, and they disappeared. That share price is now 90p, and we think there's still sort of upsides, like we've mentioned on this call, when we look at the valuation. But when you look at the fundamentals, like my other retailers, it's taking market share in its 2 markets it operates in the UK and in Nordics. It's a market leader in AI coming to the consumer. It's got a 75% market share in Microsoft AI pilot in the UK. It's got servicing and credit offering, which increases margin that other competitors can't operate. It's got a strong balance sheet. We called on the company to sell their Greek operations, which they did, which moved it from net debt into net cash. It's just come back to the dividend list. It's had about 5 upgrades in the last 6 to 9 months because it's outperforming on that market share. And the other thing we like when we look at stocks is hidden value. And within Currys, they own a business called ID Mobile, which is an MVNO, a mobile operator.
Yeah.
And it's got 2.1 million customers. It's growing at 30% a year. It's just had its fundamentals strengthened because of the remedies on the Free Vodafone merger. So it's in a very strong position. And when we value ID Mobile, it accounts for half of the market cap. And not many analysts are talking about this. So if they sold that, if we came in tomorrow and they said they've sold it, the share price would be up 50 or 60%. Now, we're not saying they will because it's growing very quickly. But we've got hidden value. We've got a very low starting PE, 8 times PE, strong balance sheet, market share gain. It comes back to this smorgasbord I was talking about. You see that when you look at a number of the things in the fund.
Okay, and Randy, let me give you a chance to. And it doesn't, I mean, it's UK, but you can talk. You're international. If there's something else that you want to talk about, please do.
No, I'm just laughing because people that know me know that I love growth. And I've talked about a brick company, and I've talked about Victoria on this, which is not, people expect. So I'm going to do in the same amount of time what James Lowen just did, but just with a basket. I think fundamentals matter, valuation matters, absolutely. And on the other side of the spectrum, the arc, which is why I think the UK is interesting, is there's still disruptive technology. So, Renalytics, for example, a unicorn down 95%, literally changing the prognosis of kidney disease. I'm looking last December when funds are just punting out all of their tax losses, right? And I look at all of these as now what's being reported in the RNS feed, what James Lowen said earlier, as the canary in the coal mine. This week Renalytics came out and said they're growing sequentially 49% quarter on quarter. Mm-hmm. No one cares because it's down so much and everyone's like, it's a show me story, but that's the canary in the coal mine to me, right? Angle PLC, another forgotten darling, up 50% year to date because this week they came out and said Illumina is doing stuff with them. And by the way, for your audience, they're the only FDA approved circulating tumor cell capture, meaning if you unfortunately have cancer, when they do a biopsy, the cells are dead. How do I see what the medicine works against a live cell? That's fascinating and a moonshot. And I don't think that the UK gets enough credit for that. And just along that bucket, Avacta, another PLC that's in the healthcare space, does the targeted delivery of chemotherapy.
Yeah.
You'll talk to someone at a chemotherapy ward and say, okay, here's your room full. By the way, cancer is happening younger and younger to people, right? And so you'll have a 30 or 40-year-old person with breast cancer who's sitting in the chemo lab coming out, and the oncologist that you talk to says, oh, it's great. They're free of cancer, but by the way, they're going to die of heart disease because tachycardia is the reason you can't do 30 chemos 3 days in a row, right? It doesn't work that way. Yeah. It'll kill your heart, kills everything. So if these guys can do targeted delivery of chemotherapy without hurting the other cells around it, again, these are all names that have to be proven. Neil's disclaimer about do your own research matters, but people come to me for disruptive ideas, and I still find disruptive ideas in the UK.
Yeah. And finally, James, maybe I can get you to talk about one name that exemplifies, your approach.
Yeah, I agree with both Randy and James. With Randy saying that you do need variety. Some of those will really work and some won't. And you do need diversification. But I'll go for one solid thing. Marshalls, the old Marshalls of Halifax, one of the best building materials companies in the UK. Share price has fallen, but there's wonderful assets in there. We will see a pickup in building activity, I think. Also, we'll see a pickup in public spend over time, and Marshalls will be there, and people will be surprised at how those earnings move forward a bit sharply, in my view, when a bit of top line growth, the earnings, the drop through could be quite quick. So no, for one would be Marshalls, but I enjoy listening to Randy. There are lots of interesting growth ideas in the UK. With a portfolio approach, it'll be great down there too.
I'm going to start moving into some of the questions. We have a few, and if we don't get through everything, what I will try and do is actually get written responses out. There's a couple just in terms of the valuation multiple and actually the health of the UK government. So I'm going to tie these together. There was a Ray Dalio quote about the UK death spiral. Is UK government debt getting out of control? And then what's the UK macro risk? Can the UK valuation multiple increase if you see GDP flatlining? How would you typically respond to that in terms of when you're looking at the market, the macro side of it? How you projecting for the UK?
Maybe I'll go first on that one. I think first of all, the sort of UK macro is better than consensus narrative, because consensus narrative is so negative, like we've been talking about in terms of expectations. So that's the first thing. The second thing on this GDP debt, obviously bond yields went up at the start of this year, and a lot of that was pinned on Rachel Reeves, but most of the bond yield rise, which has now receded, by the way, was to do with what was going on in Randy's shores with Trump and tariffs and exceptionalism over there, and that lifted all of global bonds, and that started this talk about the UK deficits. But if we look at the facts, the UK debt to GDP is actually in the lower half of the G7 on that metric. Germany's at the bottom, and then we've got Japan and the US much higher up. So even when you look at the data, it's not as bad as it's made out. And obviously, the other thing links to where growth is going to be. And I've laid out today why I think we're going to see this flatlining accelerate. Part of it is this policy change with the government, but also we're going to get interest rate cuts. I think we'll get 3 to 4 rate cuts this year. There's been people from the Bank of England Monetary Policy Committee coming out in the last couple of weeks talking about we might need 6. We've got to look through the inflation because it's going to be one-off, this national insurance sort of as that goes through into prices this year. So I think we've got to make sure we're not too bearish on the macro. It's a bit better than people think. It's not great, but there's things happening now that could make it a bit better. And like James Henderson says, we don't need much, just a little bit of oil in the system, and we're going to see these companies which are already in good stead start to move forward.
Okay, thank you.
And on that point, a lot of these companies have cut costs. It's not like they're doing nothing right now, right? Again, I've mentioned Victoria. They've taken out $80 million of their cost. It's a flooring company, should grow 3%. It's not, it's flat. But once growth comes back, you've taken out 80%, 80 million pounds of cost on a company that does, in a good environment, 200 million of EBITDA. That's really interesting. But I think, James, your other point, then, because I look at it from a really global perspective, is interesting on the rate cuts. You know, all over the world, especially all over Europe and the US as well, although this week we did not cut rates. Rates are being adjusted. However, in one country, they're not, which is Japan, which after 2 decades or something is going against the consensus and raising rates. So obviously starting from zero. So the base is a little different. But the concept of, would I rather invest in a company, in a country that's raising rates, and we know what happens there, or in an ecosystem where rates are coming down? I also agree. You know, this morning, the GDP numbers for the fourth quarter came out for Europe. And while the UK is flat since the election in July, you know, Germany is down 20 basis points. France is down 70 basis points year on year, right? So it's not as though the UK is an outlier in this. I think, to your point, James, expectations are so low that if anything, again, Hale, go home, tell your spouses tonight, Hale, don't tell them, just live the life. The point is, when you exceed expectations, all of a sudden, the money that left in the 40 odd months out of whatever, 43 out of 44 months, flows start to come, because the risk that we have today is concentration risk, and everything's in that Magnificent Seven. And when, I'm not saying it's going to happen today, but when that tide turns, smart money will start looking for opportunities. And among other geographies, the UK is one where they're going to find some.
Okay. A couple of questions which I guess tie into the people who are running the companies, and you know, are they particularly in the UK, are they effective in terms of communicating their investment case? Have you seen that change, and how does that compare with, perhaps, I don't know, I mean, James, I know you do some international investing. How's that compare with James Henderson? How's that compare with some overseas peers? And then the second question was, is that the compensation gap between the UK and the US, is that a concern for you, and is that going to hold back succession plans in the UK and the ability for UK companies to actually protect talent and realize value for shareholders? Does anyone want to take either of those?
Should I go first?
Yeah.
I think on the money, the UK will pay its chief execs less, but you know, we are a smaller place. I don't think it's not really the only motivational force for most people. The motivational force is the excitement and the fun of growing a business and watching it grow around them, and that is probably more important. They're all well paid. They're not. It's not as though. So and it has increased a lot in recent years for the top one. So I think it might be over exaggerated, and it's a good thing for the press to talk about. You know, it's intellectually easy to grumble about people's pay. It's not really about what's happening in companies. As regards presenting, I think in all geographies, there are people that are open and honest and tell stories well. I don't think that's particularly changing, and there are some people that are very good at spin and keep spinning, and the job of the fund manager is to try and work out which is which. I sometimes think, I used to think Americans were better at spinning than us, but I think we've learned quite a lot of lessons. We've got some chief execs who are very good at it now.
Just to add to that, so I think, and we sort of touched on this, the quality of management now is much, much better than 20 years ago. You see that very vividly in the banking sector, but it's the same in other sectors. So obviously that feeds through into communication and clarity. I think when we have meetings, and James and Randy will have experienced this, most of the last 5 or 10 minutes of a meeting is talking about the share price. What can they do? It's too low given the operational performance, capital allocation, dividends, buybacks, bolt-on acquisitions. And I think they've had to sharpen their communication because of that. So we've had lots of mini capital market days rather than big capital market days, trying to educate the market, but it hasn't sort of moved the needle. And I think what we've moved on to in the last sort of 12 to 15 months is companies are worried about the valuation and takeovers. So they're starting to do things now before that happens. So the Currys Greek example was a good example of that. Another example, which we will all know about, is when ITV about a year ago sold BritBox. No analyst had it in their model, and they sold it on a PE of 55, and the PE of ITV at the time was 7. It's about 8 now. And the share price went up 13% on the day because they said they were going to take the funds that it raised, which was 10% of the market cap, and do a buyback. So companies are starting to look at and unlock value themselves. Another example is TPI Cap, where they're selling or going to demerge into a potentially US IPO, their data business, which is worth much more than the sort of overall market cap has it for. So I think we're starting to see companies internally try and outvalue, and that's part of the solution for this as well.
And I think James is totally right. Every management is aware that their stock price is not doing great, right? It's not like this is new news and you don't know it. There's a company that's having capital markets day today, public policy holding company, PPHC, that had an 8+% dividend and dividend yield. And the truth is, if they're not going to get value in the market for it, they've cut that dividend this week. They made an announcement, and they're going to use it to repurchase shares or take actions that are shareholder friendly. And your pro rata ownership percentage of a growing company is going to go up. And at some point, the market recognizes it, whether that's through another strategic coming in or a financial player coming in to bid for your company or the market itself. But it's not as though this is all happening in stasis. And the last thing I would say is people forget, with the amount of takeover last year, corporate M&A, corporate lovemaking, as we say in the US, tends to be the hint of the market recovery to come. Smart buyers are buying when things are cheap, and then the general market catches up and starts to move with it.
Yeah. So, I mean, within the I'm going to take a couple more questions. One, actually, which was sent to me before the actual webinar started. Within the piece that we put out in December, one of the things we reflected on is concentration risk. The more concentrated your portfolio, the higher the volatility you would expect, and you need the returns to compensate for that. There was a stat that Chris Mayo shared about the fact that we talk about UK equity outflows of 40 plus months of consecutive outflows. He shared that the active US equity funds have suffered outflows in 119 of the past 120 months. And really what you're seeing, driving that is a shift effectively into passive, right? So much flow has gone into passive, and that in itself is leading into flows into the Magnificent Seven. Now, clearly there is concentration and herd risk within all of that. And so, the more concentrated, once that reverses, you'd expect a cascade coming out the other way. How do you pitch effectively, this is the time for active equities? How do you wake people up that actually, if you're thinking about risk, this is now the time for active equities? And I guess tied to that, passive works because costs are low. How important is stamp duty reform in terms of changing that?
Maybe I'll just go on the first one. I think in the UK, we've got our own concentration risk. I call them the Magnificent Seven. In the UK, we've got 7 stocks which are defensives, things like AstraZeneca, Relics, London Stock Exchange, which are quite expensive. And they make up 25% of the FTSE All Share. Now, if you go back a decade, those 7 stocks were 12%. Now, a lot of that has been the re-rating up to 25 or 30 times earnings on a couple of them. Yeah. And I think there's 2 markets in one. There's those and stocks like it that are very, very expensive. And then there's all the other stocks that we've been talking about today. So the aggregate UK is very cheap, but the bits we're talking about are even cheaper because they're sort of balanced off by that. So going back to the question, I think this is exactly the time not to be passive, because you've got such big weights in these stocks, some of which I've just mentioned, And I think the next decade is going to put the active industry back on its front foot and repoise it.
Is there anyone else who wants to add into that?
I'm reminded of that John Maynard Keynes line that, the market can be irrational longer than you can be solvent.
Yeah.
Right.
Yeah,
and that's the risk.
Yeah.
The risk is, the valuation is low and it's great. And you know what? 24 more months of outflows. Right.
Yeah.
But at some point, the passive movement has to come to terms with the fact that it's so concentrated in, whether those are, like you said, the LSE and other 7 defensive stocks or 7 Mag 7, the concentration has gotten too big. I'm not calling the market top at all, but it is certainly, diversity is good. Not going tilt is good. And the way you do that is you diversify and find other ideas.
Okay. Randy, I'm going to give you the final shout because you gave us hail. And I think it's a question more around sort of, how you describe things. You're a US manager. Is the FTSE 100 a mid-cap index to you?
Yeah. I mean, this is one of these things. My preference is GAAP over IFRS because that's what I came up in. And there's no GAAP. That's the generally accepted accounting principle definition of cash flow. There's no GAAP definition of free cash, right?
Yeah.
Like it's all, we use the terms, but there's, we may differentiate what it is. And so, on my small cap international, I'm buying anything under 5 billion.
Yeah. Okay.
So, there's no mid cap, there's no North Star that says 500 million or less as micro. And so, I do view it as mid cap, and that's what I see as the opportunity too.
Yeah, no, thank you. I must thank all of you. You've been brilliant. It's been a pleasure talking to all of you. I hope, in a year's time, we reflect back on what was discussed here and the UK has. I do find it extraordinary that the valuations are there. I saw that PwC survey in terms of where companies will deploy capital, and the UK was second off based on its positioning on AI in terms of digital economy. So, Randy, I do think that we're an innovative economy, and that's going to change things. And lots of other activity in terms of capital markets reform may stimulate the UK economy. The picks are really interesting. I do think it's a time for active management for that. So let's hope in a year's time it's past the morning, we're at afternoon, things are looking a little bit brighter. Thank you all.
Thank you very much.
Yeah,
Thanks, guys.